This is problem 7.14 from Brigham and Houston's Fundamentals of Financial Management, Concise 9th edition. Lord's Corporation's got a 12% coupon rate, semi-annual payment, $1,000 par value bond maturing in 25 years. They can be called 6 years from today for the par value of $1,000 plus a $25 call premium. They sell today at a price of $12.7856, so they're selling at a premium. The yield curve is flat, and that means that whatever the yield to maturity is today is expected to remain constant, all else held constant, out over the rest of time. So, and there the problem says interest rates are expected to remain at their current level, so it doesn't matter how many more years it's got to go. We're from the problem, the assumptions yield to maturity stays constant. What's the best estimate of these bonds' remaining life? Well, what that's getting at is what's the yield to maturity and what's the yield to call on these two bonds, because if the yield to call is lower than the yield to maturity, we're going to assume the bonds are going to be called. Go back here, and since I already have this crap put together, I'm just going to copy it over here into this particular problem, and then just change the numbers that change. Alright, these bonds are currently selling for $12.7856. They have a 12% coupon rate and semi-annual payments. So 12% is $120 a year, but it's in 2 installments. The par value is $1,000, but if they call the bond, they'll have to pay $1,025. That's given in the problem. If they're called 6 years from today at $1,025. If they go to maturity, that'd be at the end of 25 years, then the investor gets back their $1,000. All right, the number of periods. If they go to maturity, there'll be 50 total payments of $60 and then $1,000 at the end. The semi-annual rate is 4.57, so the annualized number would be the semi-annual, the 6-month rate, times 2. And pretty that up. Copy it over here. If we assume that they call the first chance they can get, which is 6 years from today, then I would assume that there'll only be 6 years with 2 payments a year. There'll only be 12 payments of $60, and then I'll get $1,025 for the same $12.7856 payment. The yield to call is lower than the yield to maturity. That's the number that, as an investor, I would expect this to happen. I expect that I would get 6.64% because the bonds will be called first chance they get. If Lord's plans to raise additional capital and wants to use debt financing, what coupon rate would they have to set in order to get new bonds issued? The current market interest rate for Lord's company would be 6.64%. That's because the assumption is these bonds are not going to maturity, that they're going to go for 6 more years. The yield to call would be the market interest rate that the market is expecting for these bonds. Okay? That the price of the bonds is determined in a free market. So investors out there buy and sell these things based on the assumption that the bonds are going to yield 6.64%. If Lord's company wanted to issue brand new bonds tomorrow, that's the rate they would expect to get. So investors expect to get the lower of these two numbers. The lower of these two numbers would be the rate that Lords would have to pay for new financing.